So we're still talking about inventory and cost of goods sold. And just like you do with things in your refrigerator, like eggs, for example. There's a flow to all of this. So in this video, we're going to chat about inventory flow and from a physical standpoint and an accounting standpoint. Now, from a physical standpoint, most inventory is going to come, the first stuff that comes in is going to be the first stuff that goes out. So the physical flow is always, I'm not going to say always, but generally, physical flow is first thing that comes in is the first thing that I'm going to sell. So physical flow the first items in are the first items out. Okay? That's the physical flow. The accounting flow can be different. The accounting flow can be different. The accounting flow, and we're talking about the accounting flow of costs. So all those costs that we talked about, the accounting flow can be different. So here we're saying the first costs. One of the flows can be the first costs in are going to be the first costs out. That is one flow, and that mirrors our physical flow. So this, it makes sense that physical flow and accounting flow for the costs. Again, be careful with this. It's not the unit, it's the cost. Well, it's obviously going to be the units attached to the cost, but we're looking at the costs here. How the accounting flow of costs work. And there's a few others. Crazy, but there are. Another accounting flow for these costs could be the average costs. So if it's not the first cost in, then the first cost out, is I'm going to add costs I'm going to add costs in, calculate the average, and then it's average costs out. Remember, this is only talking about costs. So I've got X number of dollars of inventory. I add some more cost in there for units, right? This is all based on the units. Bring some units in, got the same units. Going to calculate a new average of the costs, because maybe these costs that just got added in were more or less than the costs that were already in there in the average. We're going to calculate the average, and then we're going to take out the average costs. And that cycle repeats itself. I keep adding new costs in, I calculate a new average. How frequently I calculate that average depends on how you want to run your business. And then this one, the next one, is not, it's not often seen. And there's a lot of discussion in the accounting literature about it, but why spend a great amount of time on it in this class when you may never see it? And when you do see it, then you can do a little bit more digging. But they devote so much time in in textbooks, and it's just, and this is what it is. The last cost in is the first cost out. Not frequent. That's not frequent. And each of these three methods have they have a shortcut way of looking at it. This one is referred to as, we're just removing costs. This one's referred to as FIFO. This one's referred to as average cost method. And this one is referred to as LIFO. Remember, last cost in are the first costs out. This one's not frequent. Not frequent at all. So we've got to look at these physical flows and try and get a feel for how our company, whatever company we're looking at, how do their physical flows physical flows are generally always going to be this, but their accounting flows may be different.